Welcome, everybody. My name is Andrew Patricio, and over the last 30 years, I've run my own business. But for the last 20 years, I've worked with business owners just like you, encouraging them, motivating them, educating them on how to build a successful business. And one of the challenges I find that a lot of businesses have is the financial part of the business. They really don't grasp the concept always. They sometimes wing it. They price their products and services based on information that they haven't collected. And these are some of the challenges that businesses go through. So one of my objectives is to really just improve your understanding of the financials so that you can become a better business owner. Because I want you to understand that if you understand the basics of financials, it's going to make you a better business owner. And that is really my objective, is to give you an understanding so at least you can approach an accountant or approach your bookkeeper and ask the right questions. That's ultimately the objective of my webinars, is to educate the business owner, but also to give them the power to ask the right questions. So in accounting, there are basically three financial statements. And these financial statements are the ones you're going to be exposed to on a regular basis. The first one is your profit and loss statement, or as we call it, your income statement. And that shows the revenue and the expenses for a business for a specific period of time. Now I'm going to explain that in more detail. The second one is your balance sheet. And this is often the one your bank's going to ask for. If you're going to try and raise money through your bank, they're going to ask you for your balance sheet because they want to see what assets you have available to secure the loan. And the final one is the cash flow forecast, or your budget. And this is a key one in managing the money flowing in and out of your business. And I encourage you as a business owner to work on this one. This is your responsibility. The profit and loss statement, or the income statement, and the balance sheet are usually the responsibility of your accounting people. The cash flow forecast you are responsible for. Even if you use your accountant for advice and guidance, I believe they're your responsibility. So those are the three financial statements. And then other terms that you may have heard in accounting or your accountant use or read about are management accounts. So I'll give you an example. So I use an accounting software. At the end of every month, what I do is I take all my financials from my bank statement. So I download my bank statement, I upload it into my accounting software, and it'll give me the performance of my business last month, for example, if I'm doing it for last month. And this just gives me an idea of how my business did last month. There are a couple of adjustments made on this, and that's why it's not 100% accurate, but it's a good enough gauge for me to understand what's happening in my business. So if anybody ever speaks about management accounts, you know what they are. They're your monthly financials of what's going on in your business. They're prepared monthly, and the good thing about these is when you do forecasts, you can compare your monthly revenue and expenses to what your predictions or your projections were. So it's a great way of managing your business. And then we have annual financial statements. These are the documents that your accountant will prepare at the end of the year. So if your financial year is like a calendar year from January to December, after December, your accountant will start working on your financials. Obviously, you're going to have to give them all the information. So they'll prepare an income statement for you, and they'll prepare a balance sheet, which they'll submit to the revenue department, showing the profit and loss that you made in the previous year and what assets and liabilities you have in your business. So let's discuss budgets. Now, just before I go into a little bit of detail, let me just go a little bit off track. But every one of you have probably heard the term budget, and usually relates to government. So your local city or your local state or province or your country creates a budget every year. And what it is it's basically saying, what are we going to spend our money on over the next 12 months, and where's the money going to come from? And I want you to do exactly the same thing in your business. Try and determine over the next 12 months, where's the money going to come from? And secondly, what are you going to spend this money on? And budgets act as a guideline for you. And it can really help you grow your business. Because if I know, for example, that my budget says that I should only spend $1,200 a year on telephone, that is what I'm going to try and stick to as closely as possible. So budgets act as a guideline. It's really a way of setting goals. For example, I might set a sales forecast for myself. I might say, next year I want to do $375,000. That is my sales budget. I'm basically predicting, or I'm doing a forecast for the next 12 months. And the nice thing about budgets, they act as a guideline, really, because at the end of the month, what you do is you go back and you check, how did I do compared to how I projected what I was going to do. And that really helps you keep on track. And as your business grows and evolves, this document becomes more and more expensive, more and more important. I don't know why I thought of the word expensive, but more and more important and more relevant because you want to try and save money and you don't want to spend too much money. So really it helps you achieve that. And it creates cost awareness among your staff. If you don't explain to your employees that just randomly spending money has an impact on the profitability of the business, they are just going to spend money when it suits them, or they're going to just order stuff when it suits them. But we've got to create this cost awareness. Actually, I would encourage you to create incentives for your employees so they can control their costs. When it comes to doing forecasts or budgets, business owners often want to know, where do I find the numbers? Where do I get these numbers that I can use to prepare these budgets or prepare these forecasts? And the easiest answer I can give you is you can look at previous years. You can look at previous years and see, how did we do last year? What was our rent as a percentage of our sales? What was our marketing as a percentage of our sales? This is what you can do. Now, that's the advantage if you're an existing business. If you're an existing business, you'll take previous year's numbers and you'll project them forward. If you're a brand new business, this becomes far more difficult. And I know a lot of business owners struggle with this. If I'm running a program for startups and they say, well, doing this forecast is really difficult. And I say, I know, but it's also very, very helpful because it helps you determine the viability of your business idea. So this is why it's very important that even if you're a startup, you do a cash flow forecast or you create a budget for yourself. And you'll get these numbers from speaking to similar businesses. Obviously not easy to do, but go out there, ask the questions, and you'll be amazed at how much information people will share with you. And also speak to your accounting people because they may have some experience in your industry, and this is how you do it. So let's go through the financial statements. Earlier on, you heard me mentioning, or hopefully you heard me mentioning, the profit and loss statement. We also call this the income statement. Actually, this is maybe the more common statement, the more common term we use the more common one that I use. I've always known it as an income statement. And what is this income statement document? It measures the performance of your business for a specific period of time. So let's use an example. It could probably, if you're a small business, it'd be your last 12 months. So for the last 12 months, this is how much revenue I generated. These are the expenses I incurred. But you can also do it quarterly. You can do it monthly, whatever works for you. For example, in my accounting system, I can do quarterly income statements. So what revenue have I generated over the last quarter, what expenses have I generated, and I can create a very simple income statement that keeps me on track, keeps me on focus, and helps me determine how's my business doing. So that's the first document. So it's a record of all the income and expenditure incurred in your business, and it's historical information. So it's talking about the last 12 months, the last 3 months, and it's actual figures. And this is the key thing. When expenses were incurred, that is when they go into your income statement. So a telephone account for January will go into my January income statement. A telephone account for February will go into my February income statement. And it tells you how much profit or loss the business has made. So it's quite an important document because you've got to understand that you want to build a profitable business. That is ultimately what we get into businesses for, is we want to build a profitable business. So we need to know how much profit we're making. Or if you're making a loss, we need to know how bad that loss is so that we know what needs to be done. So for me, this document is very, very important, and one that you should discuss every year with your accountant. So once they've produced it, you need to sit down with them, or actually before they submit it to the revenue agency, is sit down with them and discuss it. Discuss your revenue, discuss your profit, discuss ratios, discuss your net profit, discuss all those things with your accountant. It's really useful information. So some of the terms that you will often see or hear about in the income statement, the first one is your gross profit. So gross profit is usually at the top of an income statement. You'll have revenue, you'll have your cost of sale or cost of goods sold, and then you'll have your gross profit. And it's very important that you measure that figure. That is one of the first ratios that we measure. So let me explain that to you. Let's say, for example, I'm in a retail type business. I'm in a retail type business, and I want to check how effective my pricing is. Am I competitive? One of the first things I could measure is my gross profit. So I could speak to other business owners and say, I'm in the retail business, I'm coming out at a gross profit of 26%, is that good or bad? So that is one of the first benchmarks, the first ratios that we measure. So if you're in the retail business, this is a very important one. But so is it important if you're in the service business. Let me give you an example. Usually a service business doesn't typically have a cost of sale. But my business is a service business, and it does have a cost of sale. So I contract out a lot of my work, so I put that in as a cost of sale. So I've got a gross profit figure, and I'm going to be measuring that every year, because if my gross profit comes down, that means that I'm using too many contractors or that they're charging me too much. So it's a very important percentage to measure, because it'll tell you a whole lot about your business. If your gross profit comes down, that could mean a few things. It could mean that you're undercharging for your products or services. It could mean that your suppliers have increased their prices, or it could mean that you've got too much shrinkage or pilferage in your business. So it's really important that you understand that. So that's how we calculate our gross profit. And then you have another term, markup percentage, which I don't like talking about, but often business owners will speak about their markup being 100% or 200%. Basically what they're saying is on the cost price, how much have I added on to this? So those are some of the terms that you'll find in your income statement. So I've used this word ratios a couple of times. So let me explain to you what a ratio means. A ratio is your expense in your business divided by your revenue. So let's use an example. Let's say that my advertising is $10,000, so that's what it was last year, $10,000, and I did a revenue of $100,000. That means my advertising and marketing was 10% of my revenue. So that's what ratios are. Ratios are a percentage of your revenue. So as a business owner, you've got a true gross profit percentage, which is what your income statement tells you. So at the end of the year, your accountant actually does up your numbers and says, well, your gross profit for last year was 26%. But you may have a theoretical one. So based on how you price your products or services, let's say, for example, my income statement gross profit was 26%, and I was using a percentage of 30% as my gross profit percentage. The difference is 4%. And if I can explain that 4%, that's a really good thing. If I can't explain it, I need to know why my projections and my actual numbers were different. So I need to know that there's an issue in my business. And this is how we use ratios to measure ratios in our business. So this is what I expected my gross profit to be. This is what the actual figure was. Let's work out why there's a discrepancy. The other thing you need to measure in your income statement are your expense ratios. And some of the most important ones to measure, or the biggest expenses typically in a business, are their rent, are their labor, and maybe advertising and marketing. Those three are key expenses in a business. So you need to measure these against your revenue. And then you make a comparison every year to the previous year. And then you can compare it to industry averages. So this is some of the information we get out of the income statement. And you don't have to understand the stuff 100% to discuss with your accountant. But I encourage you at the end of every year to sit down with your accountant and say, I'd like to discuss some of my ratios and see how I'm doing compared to previous years and see how I'm doing compared to similar businesses in my industry. So really, this is measuring how effectively you're running your business. And as a business owner, you want to do this on a regular basis, especially as your business grows, because every 1%, the profit you lose, if you're making $100,000, that's $1,000 out of your back pocket. You've got to understand that. So expense ratios help you measure how you're doing relative to previous years and how you're doing relative to other people in your industry. And the other thing you're going to measure is your net profit percentage. So you want to look at your industry average. Across North America, I don't like using averages, but I'll give you an average anyway. Net profits are usually about 10 to 15% of revenue. So what does that mean? For every dollar that you sell, 10 cents is net profit, which you'll take and then pay your income taxes on. Okay, so net profit is the amount that you pay income taxes on. So it's very important that you measure this and you monitor this and that you grow this as your business grows, or at least stabilize it. So your net profit percentage is very important. So often you'll hear businesses speaking about making a net profit of between 10 and 15%. That is the North American average. But again, it depends on the industry. So once you know your gross profit, once you know your expense ratios, once you know what your net profit is, you can then compare this to other businesses or similar businesses in the industry, or compare it to last month or last year. And this is where it becomes really relevant, because if you realize your net profit is too low, well, you can do something about it. You can reduce your expenses, you can increase your selling price, you can reduce your cost of sales. There are so many things you can do once you know there's a problem. If you don't know there's a problem, there's a big issue. The other thing that I really like business owners to know, actually, especially if you're going to launch a new product or new service, you've got to know exactly what your break-even is. I'm going to show you a couple of examples, so not to worry. I'm going to show you a couple of examples of exactly how you do this. So your break-even is your total fixed expenses. So these are your fixed expenses to operate your business every month, divided by your gross profit percentage. So that is how we calculate our gross profit percentage. So our gross profit percentage is our total fixed expenses, so our monthly fixed expenses in our business, divided by our gross profit percentage. And this is a very, very important number to know, because you want to know what needs to be done on a regular basis. So I'm going to show you an example here. I'm going to show you an example of how you would do this. Let me just show you this example. I'm just going to share my desktop with you. So I'm going to share my desktop with you, and hopefully there's nothing you shouldn't see. There you go. I think that's okay. There's nothing here you shouldn't see. Let's see what I've got there. That's what I want to open. Okay. So let me give you an example. Let's say, for example, my business costs me $7,524 a month, $7,524 a month, as we'll call my fixed expenses. Okay, so those are my fixed expenses every month, $7,524. For those of you that have got bad eyes, let me just make that bigger for you. Okay, so those are my fixed expenses, which include a salary for myself. But keep that in mind, you must include your salary in there. And let's say my gross profit is 45%. This will tell me what revenue I need to generate every month to survive. So in this case, my break-even revenue every month is $6,720. And it's important for me as a business owner to know what that number is, because that's the starting point. The starting point in any business is I've got to know exactly what revenue I need to generate every month to pay my rent, my telephone, my employees, my salary, all those things to survive. So this is why knowing your gross profit margin is very important. So knowing your gross profit percentage is very, very important, because then you can calculate your break even. Let's use an example. Let's say I want to employ a new employee, and it's going to cost me $3,000 a month, okay? So currently my break even is $16,720. If I employ this new person, my break even goes up to $23,000. Basically, to employ this new person, I need to generate about $6,000 of extra revenue, say $7,000 of extra revenue, to justify this person's salary. Okay, so this is important for me, because every single time I make a decision as a business owner, it's going to be impacted by what my fixed expenses are. So I don't just move into a premises. I don't just make decisions, I calculate them. Let's say you're a service business, okay? So let's say you're a service business and your fixed expenses are $7,524 a month. Okay, so that's your fixed expenses, and that includes the salary for yourself, making sure that these numbers are bigger for people with bad eyes. Let's say my charge out rate is $150 an hour. That means I need to sell 50 hours every month to survive. That's what I need to do. If I'm employing an assistant, and let's say it costs me $3,000 for this assistant, okay, I need to sell an extra 20 hours to justify this assistant's salary. So that's the way I make my decisions as a business owner, is can I afford this new employee? Well, the answer is, because this person comes and works for me, I sell another 20 hours, I can justify their salary. Otherwise, I cannot justify their salary. Okay, so that's the way we do things. So the break even for me is very, very important. I need to know exactly what revenue I generate every month to survive in my business. And so you need to know what your break even is. You need to know your break even point for every month. If your expenses, so these are our fixed expenses, if your fixed expenses goes up, so does your break even. So if I employ somebody new, I need to generate more revenue to justify that. And that's really what it is. If I move to new premises, I need to generate revenue to justify that. That's really how you make a decision. If your gross profit percentage goes up, your break even comes down. So this is how you justify, or this is how I justify selling things at a premium, because the more profit I make, the rest of the revenue I need to generate on a monthly basis. If my gross profit comes down, let's use an example. Let's say I start running more promotions on a regular basis. My gross profit comes down, my revenue has to go up proportionally to justify that reduction in gross profit. So these are the basics of business, but they're very, very important, because as your business grows, you want to build profitable revenue. You are in business to make a profit. Never forget that, and that's the key thing. All right, so that's your income statement. So hopefully I've encouraged you from now on, at the end of every year, you're going to sit down with your accountant and you're going to discuss. You're going to discuss your gross profit percentage. You're going to discuss your expense ratios. You're going to discuss your net profit percentage. And more importantly, you're going to discuss with the accountant what you need to do to improve these percentages. And if you improve these percentages, you make more money. And if you make more money, that's not a bad thing. All right, so the next thing is your balance sheet. So what is this balance sheet thing that people speak of? And a lot of small business owners are intimidated by the balance sheet, but I don't want you to be. All that a balance sheet is are the assets and the liabilities of the business at a specific point in time. So basically, it's everything that the business owns and everything that the business owes on a specific date. So often you'll see a balance sheet will say, as at the 31st of December, 2015, these were the assets, these were the liabilities. Assets are things that we own, like equipment in our business, like money in the bank. People that owe us money are receivables. Those are the type of things that are our assets. The things that are our liabilities are loans from the owner, so money that the owners lent us, bank loans, line of credits, any payables that we have, those are our liabilities. So those need to balance out. Our assets need to equal to our liabilities. Now this confuses some people. They say, wow, if our assets are equal to our liabilities, how do we survive in business? Is because you have a net worth. So assets minus your liabilities give you your net worth. So you've got to understand this, that the difference between your assets and your liabilities are the value of your business. So it shows the net worth of your business. But think of it, you could create a list of assets and liabilities for yourself. For example, maybe if I wanted to, what I could do is let me just share my desktop here with you. One of the things that I could do, for example, and it's a very good idea for you to do, is to write down everything you own and everything you owe in your personal life. Let's say you've got a home and that's worth $250,000. Then you've got a mortgage, which is say $152,000. Let's say you've got a line of credit, which is, let's say, $2,500. And let's say you've got I don't know, other assets. Let's call it other assets. Okay, you've got other assets of gold, diamond, furniture, all these different things that are assets that you have. Maybe you have more property or whatever it is, of $64,000. Okay, 64,000, one more zero. There you go. So I could add these up and say, well, everything I own is $314,000. Everything I owe is $154,000. So my net worth in my personal capacity is the difference between the assets, okay, minus my liabilities, which in this case is F11. There you go. So that's my net worth. So that's exactly how much I'm worth, $159,000, based on what I own and what I owe. If this was my business, I'd call it assets, but it's my personal and then liabilities. Okay, there you go. So this is exactly what we do in business, is we count the assets, count the liabilities, and here's a little balance sheet, a nice little balance sheet that I created, a simple one, that hopefully you understand. If it's your personal life, this is exactly what a very simple balance sheet would look like, okay? So that's a little simple balance sheet. If this was a business, what it'll be a little bit different. If this was my business, let's see what we could have on it. If it was my business, I would have, and I'm not going to do it like an actual structured balance sheet. I'm going to do it like just to explain it. Let's say I had money in the bank, $2,000, okay? If I had inventory, so these are some of the assets in my business. Inventory, if I could just spell, that would really help. Inventory, okay, let's say $25,000. If I had, what else can I have? Receivables. Okay, so receivables of $24,000. If I have assets at book value, and these are my assets after depreciation. Okay, so let's say assets are $25,400. There you go. So those are the assets of my business. Let's say I've got a loan of $16,000. Okay, and then I've got a line of credit of $25,000, and I owe some payables of $17,000. That would be the net worth of my business, $40,000. Exactly the same type of thing. Obviously, accountants usually make it look a little bit complicated because they've got a structure that they use, but all this information is available in your accounting system. Where do I get the bank number? From the bank statement. Where do I get the inventory? Well, I count the inventory. That's where I get the number from. Where do I get the receivables? I run through the invoices that haven't been paid, my invoices that I've issued that haven't been paid, and I will look at those, okay? And then the assets are things that I own less my depreciation. So that's the way I calculate those things, okay? So that's a very crude balance sheet that I've created for you, but just so that you understand that your personal and your business could be really simple. So somebody's asked me a question, yeah, and they've said to me, what is the current ratio? Okay, so those are your current assets and your current liabilities, okay? So really, what is the one compared to the other? So let's use an example. So if any of you remember the financial crisis, if you had a line of credit, your bank might have phoned you and said, listen, things are bad. We want you to repay your line of credit immediately. This is where the current ratio is important, is do you have enough cash to pay these things? So if you liquidate your inventory, if it's you take the cash out of the bank and your receivables, if you could cash that all in, will it cover all your current liabilities? So that is what a current ratio is. It's your current assets divided by your current liabilities. There you go. So there's your current ratio. I knew you were going to ask Norm, so I thought I'd put it on the screen. Your current assets divided by your current liabilities. So basically, if the bank had to call you and your suppliers had to call you now, do you have enough money to pay them immediately? And usually, again, it depends on the industry, you want to try and cover it twice. You know, so you want to have twice as many current assets as you have current liabilities. But again, it depends on the industry. I don't like making too many generalizations. All right, then you have a thing called your stock turns. So what you do is, let's say my revenue last year was $300,000. And let's say my inventory at selling price is $20,000. The amount of stock turns or inventory turns I got was 15. Okay, so on average, my inventory is 20,000. I do a revenue of $300,000. My stock turns are 15. Is that good or bad? Well, it depends on the industry. You look at what other people have done, you look at your previous year's numbers, and then you get this information. Another thing that your accountant could measure using your balance sheet is your debtor collection period. So how many days does it take you to collect your money? Is it 30 days? Is it 34 days? Is it 36 days? Is it 42 days? This would influence your bank's decision about whether they would finance you or not. Because if you're taking too long to collect your receivables, the bank maybe won't lend you money, okay? Then your creditor payment terms is how long you're taking to pay your suppliers. Are you taking 30 days? Are you taking 45 days? Are you taking 60 days? These are some of the things that they work out. Then your debt ratio is what are your total assets divided by your total liabilities. And your total assets should be higher, which is obvious, but these are some of the things that banks will measure before they loan you money. And it'll tell you how to evaluate a business. So you can use these ratios to evaluate a business. All right, so the third document we have, remember we started off with the profit and loss statement, or the income statement as I called it, and I showed you how to calculate your break even. And if any of you want these templates, you just email me and I'll email them to you. And now I'm going to show you the cash flow forecast, because the cash flow forecast for me is the most important document for any small business owner, including myself. Because the one lesson I've learned as a business is you never, ever want to run out of money. So I'm obsessed with having money in my business, because once you run out of money, you lose all your friends and nobody wants to do business with you. So what is this cash flow thing we speak about? It's a document that you prepare in advance showing the estimated money coming into your business and going out of your business over the period of time. So I do a cash flow forecast for my business for the next 12 months. And really, these are guesstimates. I'm calculating based on what I know about running my business, what I'm going to do next year. Okay, and this depends on my business plan, depends on my marketing, depends on my industry, all these type of things. So I'm doing a forecast. It's very important that I do this, because this is going to help me manage my business. It's going to help me manage the cash in my business so I don't run out of money. And if I see there's going to be a shortfall of cash, then I want to start planning for it. So I want to start If I need to apply for a loan, I want to do it in advance. If I need to borrow from my family and friends, I want to do it in advance. You never want to borrow money when you're desperate. Never forget this. You never want to borrow money when you're desperate. You want to borrow money long in advance. So the nice thing about the cash flow, you use it to assess the timing of money coming in and money going out of your business. And it helps you determine whether you can afford to pay a loan. For example, you might decide, one of the decisions you may make as a business owner is you want to buy the property or the building that you currently rent. Now, the question is, can you afford it? Well, the answer is it depends on your cash flow. If you've got enough cash flowing into the business, you can afford it. If you don't have enough cash flowing into the business, you cannot afford it. So cash flow is key. It is really, for me, the most important thing in my business is that cash is flowing through it. It helps you determine whether you can afford to pay loans. It helps you budget for major purchases. So if I want to make any major purchases in my business, maybe buy equipment or even inventory. Let's say I want to take advantage of a special discount. Well, I've got to know, do I have enough money to take advantage of this, and will it have an impact on my cash flow? So some things to consider when you're doing a cash flow forecast are seasonal fluctuations. This is a key thing for some businesses. We have busy times of the year and we have quiet times of the year. So you've got to be aware of this and plan for that cash flow. If not enough money is coming in, you may have to get a line of credit, you may have to lend the business money, all these type of things you need to discuss. The other thing you need to take into consideration are price increases. And for some of our businesses, this is a key issue. For a lot of other businesses, not such an important issue. Again, it depends on the nature of your business. The other one that is a big thing for me are late payments by suppliers. If you're and not by your suppliers, by your customers. If your customers are paying you late, this is going to have a major impact on your cash flow. So as a business owner, you've got to manage it. You've got to manage this, you've got to pick up the phone, you've got to phone these people and make sure that you collect your money. And then emergency situations. And here's my rule to business owners, or my advice to business owners is, when you're doing cash flow forecasts, I encourage you to be conservative, especially in your sales forecast. Be very, very conservative. Exaggerate your expenses and be conservative in your sales forecast, because this is the right way to do things. Take every situation into consideration. So when you're doing forecasts, do that. How do we improve our cash flow? So cash flow is a common problem in small business, cash flow issues. You hear business owners regularly speaking about cash flow issues. Adjust your prices. Sometimes just increasing your prices is the right decision. You make more profit, you may lose some customers, but it's going to help you become a more profitable business. So that's the first thing you can do. The second thing you can do is reduce your cost of sales. Renegotiate with your supplier. Negotiate with them, try and get a discount, and that will improve your profitability, which will improve your cash inflow because you're making more profit. Sell more for cash. Don't be afraid to ask for customers to pay you up front. Get credit card payments, get checks up front, whatever, but you need to get cash flowing through your business. Reduce your receivable terms. Just be consistent. If it's 30 days, it's 30 days. If somebody's paying late, you need to follow up, or get somebody in your office or your accountant to follow up with your receivables so they pay on time. Increase your payable terms. Some of us were brought up like that. An account arrives, we pay it straight away. In business, that absolutely makes no sense. Take whatever terms your suppliers will give you and use their money to help you grow your business. Reduce your operating expenses or your fixed expenses or your fixed costs, whatever you like calling them. Set yourself budgets and monitor your advertising. Because if your advertising's not working, it's not generating revenue, which has an impact on your cash flow. So you've got to make sure that you monitor that. So these are very, very important. So let me just summarize. To survive in business, there are basically three documents or three financial statements. The first one is the cash flow. I'm going to go in reverse order now. The first one is the cash flow. You as a business owner need to create a cash flow for the next 12 months. Sit down with your accountant and work out what money is going to flow into your business, what money is going to flow out of your business over the next 12 months. So you can monitor it and see if there's going to be shortfalls, you can address these. Also use your cash flow statement to set budgets for your employees. So you control your expenses. That's the first one. The second one is your income statement. At the end of every year, sit down with your accountant and discuss it. What was your revenue like last year? What was your gross profit? What are all your other expenses relative to your sales? What was your net profit? So compare yourself this year against last year and maybe the previous year and against industry averages. Because if there's a problem, you need to address it. If your gross profit percentage is too low, why is it too low? Is it because your cost prices have gone up? Is it because you've been offering too many discounts? Is it because there's been too much shrinkage or too much theft? Whatever it is, you need to know what that is. So your income statement tells you a whole lot about your business, and this is why you need to analyze it. It's going to make you a better business owner, and that is the key thing. If you manage your expenses, you can make more profit. It's very, very simple. Then finally, you have your balance sheet. Your balance sheet is basically a statement of all the things that you own and all the things that you owe. And as a starting point, maybe start off by creating a balance sheet for yourself. On the one side of your spreadsheet, put all the things that you own. On the other side, put all the things that you owe. And for some of you, it'll make you really feel good that you've got some equity. For others, it'll scare you because you realize that you hardly own anything. But that is the starting point to understand what the balance sheet is. And then look at your business's one. Your business's balance sheet will have assets. Those are things that the business owes. And then it'll have liabilities, and it'll have the net worth. Okay, so assets minus liabilities will give you your net worth. And that's ultimately what we are in business for. So the key thing is sit down with your accountant, discuss your financials, and become a much better business owner. That is my wish for every single one of you. And really, the financials are not complicated if you simplify it. It's the income statement, it's the break-even point, knowing what that is, creating a cash flow every year, and your accountant discussing your balance sheet. I don't want you to know too much about the balance sheet, but just understand that it's the assets and liabilities, and that your assets should be higher than your liabilities. And if you do that, you can build a very successful business. But I still believe that you cannot build a successful business unless you have a basic understanding of the financials in your business. So get out there, start off slowly, start understanding at least the income statement and the cash flow forecast, discuss it with your accountant, use this information, build a successful, profitable business, because that's what you want. And that's my wish for every single one of you, that you build a successful, profitable business and achieve all your dreams.